From time to time, a corporation will buy back its own shares of stock. That's called treasury stock. Maybe we buy it back because we need shares to give to our officers when they exercise stock options. Maybe we want to increase our earnings per share in the short run. Maybe we want to prevent a takeover, or maybe we want to send a signal to the market that our stock is undervalued. Whatever the reason, we call that treasury stock when we buy it back. And we're occasionally going to sell it again. There are two different ways to account for treasury stock: the cost method, which is widely used, and the par value method, which is seldom used. Let's start with the cost method, and let's look at exercise 13-30. Here's our stockholders' equity section of our balance sheet. We have 240,000 shares issued and outstanding, and we have $240,000 in our par account, which makes sense. It's $1 par. We have 240,000 shares outstanding. We also have $3,840,000 in our paid-in capital in excess of par. So that means that our average sales price must be $17. Take these two totals, divide them by 240,000 shares. On average, we sold our shares for $17 each. $1 was credited to par for each sale, and $16 was credited to additional paid-in capital common stock. In other words, paid-in capital in excess of par. Let's look at some of the treasury stock transactions in this homework problem. On June 1st, we reacquired treasury stock at 15,000 shares at $16 a share. That's easy to book. All we have to do is debit treasury stock, which is a contra equity account. It hangs around in the equity section of our balance sheet, but has an unusual debit balance. We paid with cash, so we credit cash for $240,000. Then on July 1st, we sold 5,000 shares of those shares of stock at a gain in quotes, of $4. So we got $100,000 cash. Treasury stock we're going to credit. Stuff was on our books up here at $16 a share. So when we sell 5,000 shares, 5,000 times 16 means we're going to take $80,000 of that treasury stock off our books. That journal entry doesn't balance because we had a quote-unquote gain of $4 per share. The big thing about treasury stock is when we resell it, we don't get to book any gain or loss on our income statement because we're not supposed to be in the business of buying and selling our own shares. Instead, we're going to book gains and losses over here somewhere in our equity section of our balance sheet. In this case, we're going to book this quote-unquote gain in an account called paid-in capital treasury stock. It tells the world that we sold some treasury stock for more than what we paid for it. Let's sell some more treasury stock, but this time let's sell it at a loss, in quotes. So we're selling 7,000 shares at $14 a share. 7,000 times 14 is $98,000 we're receiving in cash. Those 7,000 shares are in our inventory, if you will, at $16 a share. 7,000 shares times $16 a share means we're taking them off our books at $112,000. That's a loss of $14,000 or $2 per share. We're going to use up some of this paid-in capital from treasury stock whenever we sell at a loss. If we didn't have this credit balance over here, we would debit retained earnings instead of paid-in capital from treasury stock. So when we sell treasury stock at a loss, quote-unquote loss, we're first going to reduce any gains we previously recorded, and once we use all those up, we'll start eating into retained earnings and decreasing those with debits to reflect those quote-unquote losses. Finally, let's retire 1,000 of those shares. Well, remember that we originally sold those shares at $17 each. So $1,000 shares, times the $1 par means we're going to take $1,000 out of the par account. We also sold them at an average of $16 over the par account. So we'll take $16 times 1,000 shares. So we're going to take out $16,000 from the additional paid-in capital common stock account. Those shares were on our books at $16 a share, so we're going to take them off. That journal entry doesn't balance. It's off by $1,000. So what we're going to do is we're going to credit paid-in capital from Treasury Stock. Because if you think about it, we issued them at 17, we were able to buy them back at 16, so that's like $1 per share quote-unquote gain. So if it helps you, you can think of that $1,000 to balance that journal entry as reflecting the gain we got on those shares that we got to retire. The last half of this, the last part of this homework problem asks you to create the stockholders' equity section. To save time, I'm not going to do that, but all you have to do is take these journal entries here, post them to the T accounts over here, and you'll be all set. I will give you a hint and tell you that the total of the stockholders' equity section should be $5,043,000. All right, let's take a look at the par value method. The par value method is a little bit less intuitive, and it's used by something like 4% of corporations. What it does is it focuses on the par value. We're going to use Treasury Stock as kind of a doppelganger, kind of a twin of the par account for common stock. And we're going to treat the repurchase of the stock and the sale of the stock or reissuance of the stock as two different transactions. So we're not going to track gains or losses on those sales. So let's focus on the par value method. Same transactions are going to take place. We're going to buy back 15,000 shares at 16 bucks a share. So we're going to take $15,000, 15,000 shares times $1 par, and put it into the Treasury Stock account. We're going to undo the additional paid-in capital common stock related to those shares. Remember, we had $16 additional paid-in capital per share, $16 times those 15,000 shares is $240,000. How are we going to pay for it? We're going to pay some cash. And how are we going to make that journal entry balance? Well, we're going to credit paid-in capital Treasury Stock. I like to think of this as a reflection in advance of the money we're going to make on these shares. In other words, we issued them for 17, we're able to buy them back for 16, so we credit paid-in capital for Treasury Stock for $15,000. All right, let's sell some of those shares. And again, we're not going to care about what they're on our books for. So we're going to sell 5,000 of those shares at $20. 5,000 times $20 is 100,000. We're just going to use this Treasury Stock account just like we would a par account. 5,000 shares times $1 par is 5,000. We're selling those shares for $19 above par. $20 per share sales price minus the $1 par is $19. $19 times 5,000 shares gives us our $95,000 in additional paid-in capital. Now let's sell some more shares on August 1st. 7,000 shares at $14 a share is $98,000. Again, we're reissuing these stocks, except instead of crediting par, we're going to credit this Treasury Stock account. 7,000 shares times $1 par, $7,000. How much more than par did we sell these shares? We sold them for 14. Par is 1. If par is 1 and we sold them for 14, that's $13 over par. $13 per share times 7,000 shares gives us our $91,000. And perhaps the easiest part of the par value method is retiring shares. Since we're only focused on the par value, when we retire these 1,000 shares on September 1st, we're going to reduce Treasury Stock by $1,000. That's the par value. And we're going to reduce common stock by $1,000. That's the par value. The last part of this homework problem asks you to create the stockholders' equity section. I'm not going to do that. All you have to do is take these journal entries, post them to these T accounts, and strike the balances. I will tell you that just like the cost method, the par value should yield you a total stockholders' equity section of $5,043,000, but the balances within the individual accounts will be slightly different. I hope that helps.